Welcome back to Passive Income Pilots, everyone. Tait, Duryea, Ryan Gibson here on a very special episode where it's just the two of us. How you doing, Ryan? Congratulations to the Super Bowl champions.
Super Bowl champions. And boy, did we celebrate in style in the city of Seattle. We've had a huge parade, big celebration, and some great legendary speeches by our players. Seattle never disappoints. Over 1 million people showed up for the Super Bowl parade. And yeah, it was fun. Good times.
That's amazing. Where was it? Downtown?
Downtown. They had a presentation of the Lombardi Trophy at the stadium. And then we marched kind of through the city and ended over by the Space Needle in sort of the quintessential city scenes that you get from Seattle. So I'm sure you've seen the reels and the photography from the event. It was pretty good. And hey, everybody was pretty well behaved. And I think the city pulled it off. So very excited for that.
Incredible.
Hopefully we'll get the Mariners into the World Series next year and all that stuff. But Tait, it's been so much fun hanging out. We've been hanging out today. We've been actually me and Tait have been meeting every week for the past, I don't know, month or so. And we've been talking about this for a long time, but we're going to do it. We're going to have a conference.
We are, finally.
And we have a date.
We do. So, and boy, that was a little anticlimactic, Ryan. We needed a drum roll. We've been talking about this for years. We're actually going to do an in-person event, October 8th and 9th in Las Vegas, Nevada. We're talking about bringing it on the road, maybe to Atlanta or one of the other big pilot hubs in a subsequent year. But for this year, for 2026, we're going to be in Vegas. We've got room for 130 people and more details to come. It's going to be a lot of fun. It'll be a 2-day event. Ryan and I will be there. A bunch of our partners will be there. And we're going to be talking about passive income, asset protection. We're going to be talking about tax strategy, STIRA investing, all sorts of stuff. What else am I missing, Ryan?
Oh, you pretty much nailed it. Road mapping, your financial plan, how to set goals and do all this stuff, and how all this stuff kind of works together. And we're going to hang out. It's going to be a couple fun days and nights where we go to happy hours and you get to meet, people that listen to the show, and obviously the very special guests that have come on to the show. Very, very excited about doing it. Yeah.
One of the big gripes that we've always gotten from our happy hours is that you didn't give me enough time to bid. You got enough time to bid. All right. It's in October.
Yes.
So
heck, you could even probably bid your vacation. Well, I guess vacation bidding's already been kind of out the door. But yeah, I hope everybody had a good Valentine's Day, and congrats to the Delta pilots for getting their bonus. We talked in the last episode how that's taxed and how that's treated.
We did. Welcome to Passive Income Pilots, where pilots upgrade their money. This is the definitive source for personal finance and investment tactics for aviators. We interview world-renowned experts and share these lessons with the flying community. So if you're ready for practical knowledge and insights, let's roll.
Tait, I'm dying to get into this. I know that you and I look at a lot of different investing. We look at, industrial, multifamily, self-storage, debt funds, stock market, precious metals, senior living. But I kind of want to go, Tait, what are you kind of most excited about this year? Where have you kind of focused your time and attention? And, what's the top thing for you?
Well, I'm excited to talk about some of those macroeconomic trends that we're seeing. I will say, I don't think we're going to spend a ton of time on it on this show because it's a completely full other topic that we could spend a whole episode on, but we're very excited about energy. As you know, we've brought our oil and gas previously consultant in-house, and he's now our managing partner of that vertical. So very excited about the energy space. But in terms of just the trends that we're seeing, the two real estate asset classes that I'm most excited about this year are senior living and industrial. And we talked a little bit about this with our group last week, but we're really seeing this trend of reshoring. I'll kind of start with the industrial and then we could pop over the fence, but we're seeing this reshoring and nearshoring trend where companies are bringing supply chain logistics and manufacturing back home from overseas. The globalization trend really started, back in the 90s, particularly under Clinton signing NAFTA and a lot of these trade agreements where it made sense for companies to send manufacturing, supply chain logistics overseas. And we really hit peak globalization in the late 2010s. And during COVID, a lot of the vulnerabilities there really started showing up. I use the example of Ford having thousands of F-150s sitting in a lot because they don't have a microchip that needs to go into them. And they can't sell it without the microchip. And it's like, okay, how much money are we really saving by manufacturing these things in China or wherever? And, does this wisdom still hold up? So there's been this, since COVID, this huge wave of bringing manufacturing home. And, this is a multi-decade trend that we're kind of following. So I'll pause there because I don't want to go on too much of a monologue here, but it's definitely influencing the industrial space.
Yeah, I'm really excited to bring on an industrial flex guest here in the coming months to talk about that. It's cool that you guys are kind of really focused on that. And I love that. I love the fact that we're bringing stuff onshore with tariffs and different verticals and things like that. I mean, that's another thing, right? Like
and tariffs are just an additional tailwind. I mean, it was already a trend that had started. Taiwan Semiconductor was already making the largest foreign direct investment in the United States in history, bringing chip manufacturing. Obviously the CHIPS Act was a catalyst for the start of that project. Then you throw the tariffs on top of it, but factory spending tripled in the United States between 2021 and 2024 under Biden. And, just a huge data point of, the new MacBook is being made in America. It's being made in Texas. GE is spending billions of dollars to build plants in the Southeast. I mean, it's now cheaper to manufacture in Mexico than it is in China when you factor in shipping costs. And that inflection point happened sometime last year.
Yeah, we actually bought a self-storage facility in Sherman, Texas, right next to the semiconductor chip manufacturing plant that Texas Instruments and the Global Offers plant is actually getting built right now. Right. And there's like 10,000 homes coming in or 20,000 homes coming in like around that site. Yeah. And that was something that like you said, the Biden administration actually passed, whereas a huge government spending, Sherman, Texas, just north of Dallas. And so that's been a great market for us. And we're expecting to get like some really good tailwinds from people moving there and building the factory, which has been great.
Yeah, it's almost like the CHIPS Act was the carrot and the tariffs are the stick. So it's like you got both.
Yeah, a lot of mixed signals, but GDP has been strong in the United States. And, I think what's been really fun is actually we've seen rates come down, right. So we've been buying real estate through the up to the pandemic, through the pandemic. And speaking of which, that property that I mentioned had an interest rate that was 7.5%, something like that. We call up the lender, and we now have a 6% interest rate on that property. And so that's rates are coming down, and so the cost of borrowing is coming down, and that's obviously fueling profit in real estate, and eventually values will follow.
All right, Ryan, I want to, for some listeners who maybe weren't investing in commercial real estate or syndication deals back in 21, 22, or even prior, let's talk about some historical context here. I think this would help our listener base really understand where we are in this market cycle and why we're so excited to be buying real estate today. Let's rewind to maybe the late 20-teens and what happened into COVID. Where were interest rates? Where were we in the real estate market cycle? What happened in 21 and 22, and where are we at now?
Well, I mean, I think you got to remember, go back to the 2009 recession, right? And like 2009, 2010, 2011, 2012, 2013 even, 4 years of unexciting, really kind of humdrum performance in real estate. And it wasn't really until, 2015, 16, 17, things got going. But what even further exacerbated that was the fact that interest rates went down. The Fed funds rate basically bottomed out in 2021, and it created a lot of money supply that allowed investors to buy real estate at a low cost, which then if you put more money supply in, you put a lower cost of capital in, you drive up pricing because more people can buy, they're willing to pay.
And if I may put one more data point in there, in 2017, we got the Tax Cut and Jobs Act, which gave 100% bonus depreciation on real estate, cost seg bonus depreciation, which everyone's familiar with now. That was additional fuel to the fire. So sorry, back to you.
Yeah, no. So yeah. And I think, that was a big headwind. And then we had this
tailwind,
massive COVID, thing, the pandemic that happened. And we saw a lot of manufacturing and supply chain get basically seized up globally. And that created inflation, right? It really drove up the cost of goods. Everything cost more, right? And I think, the Fed, to kind of pull the only lever that they could, they had to kind of curtail and tame that inflation. They jack these interest rates up, and all of a sudden it becomes very difficult to finance projects, becomes difficult to refinance at a lower rate, and the cost of capital just absolutely surged. And obviously that had negative impacts. It really kind of accelerated assets that maybe were already trending poorly, like malls and office and things like that. And it, created a lot of opportunities. And I think we've sort of gone through the 2023, the 2024, the 2025, similar to how we sort of had this kind of long 4 or 5 years at the bottom post 2009 recession. And then we started to see things come back together. Cost of borrowing is coming back down, and you start to see sellers sort of return to the market. You start seeing, like in self-storage, we're seeing rates starting to recover again. We're seeing a lot more efficiency. The big thing that we're seeing is people didn't build the last 2 or 3 years. They weren't able to go out and actually pull a permit and get financing and go build their property. And we're starting to see that benefit today.
And if I can, just glaze over that same time period with some additional color, the pandemic caused the Fed to do some pretty dramatic stimulus, meaning they printed a bunch of money. And when it was all said and done, the last round of money printing was about 1.9 trillion. We didn't really need that last bit. So the last bit of money printing was under Biden. We kind of went overboard. And, we talked to economists and it was like, okay, well, it would be much worse if we had undercorrected, but we overcorrected. So we put all this money into the system in late 2020, early 2021, and it has to find a home. 5 trillion extra dollars into the economy. It has to find a home. And this is when, NFTs were hot and it was like anything that people could buy, right? And interest rates the Fed funds rate was at 0. So it's like you have super cheap money, all this cash sloshing around in the economy. It's trying to find a home. Capital flows are at all-time highs. I mean, everybody's trying to buy into real estate, pushes prices of everything up. And then because real estate is so sensitive to interest rates, it was most affected by this rise in interest rates. If you're a stock market investor, you probably didn't even feel the bump in interest rates. Maybe, you're shopping for a home and it costs more to get a mortgage, but that doesn't really interrupt your life. If you're a real estate investor, if you're steeped in this segment of the investment world, I mean, it was like as bad as it gets. I mean, going from 0 to 5.5% in 14 months, that caused a huge strain on real estate, particularly commercial real estate. And so we saw valuations come down from, 2022 pricing down to, I'd say, 23 and 24. I mean, across the board, maybe an average of 30%. So we've been loving it because we're buying assets at, 2016-ish pricing over the last few years. But of course, anything that you bought in late 21 into early 22 is not going swimmingly because you bought at peak pricing. And if you didn't have fixed rate debt, your debt costs went through the roof. So anyway, that's sort of where we are. What else would you like to add to that, Ryan? There was also a construction boom during that time. So it's like not only was it peak pricing, but you had, again, dollars trying to find a home. And so people went out and built like crazy. When interest rates spiked and you had all this inflation where now you have labor costs rising, material costs rising, and debt financing costs rising, everything just locked up. And so that's where we are moving into 2026, where these big booms in deliveries in self-storage, in multifamily are now coming, the pendulum swinging the other way. And so I'd love to talk to you, Ryan, about what are you guys seeing in the self-storage market in terms of deliveries and the construction pipeline and supply demand?
Yeah, we have the lowest there is the lowest amount of self-storage being built and delivered in the market than we've seen in over a decade. So we're actually going to have the lowest deliveries as an industry this year since 2012. And so literally over a decade. And it's because, in 22, 23, 24, 25, people could not get their projects out of the ground. They couldn't get financing. The tariffs restricted that. And so for somebody who's sitting with that asset now, we're going to start seeing the benefits of that, because the biggest threat to the industry in storage is people building more supply. And when you don't have supply coming to a market, it's only going to continue to benefit you, especially in markets that have population growth. And so I'm pretty excited about that. The fact that,
Same.
there really isn't going to be the supply headwinds that we've seen in the industry.
Supply headwinds is such a good way to put it. And, we've seen the same thing in the multifamily space where, especially in key Sunbelt markets, I mean, those markets just got way oversupplied. The absorption has been strong, but still too much supply. And that will work its way through the system. What about the demand side? Because, I have a stat here. Everybody on this show knows my wife is a realtor. And there's a pretty amazing stat from last year. 71.1% of realtors did not make a single sale in 2025. That's from the National Association of Realtors. The next 14% of realtors only sold between 1 and 4 properties during the entire year. So, and we see that reflected in transaction numbers too. It was the lowest transaction volume in the U.S. in single family homes since 1993, I believe, 93 or 95. Wow. And when you adjust that for population growth, there's 70 million more people in the U.S. today. So when you adjust it for population growth, it's like even a longer look back. So, I mean, we just seen a total lockup in the real estate market where just things are not transacting. So I know that, what's the stat? An average American uses 11 square feet of self-storage per person? Did I get that right?
About seven.
Okay, I'm sorry. So have you seen that come down over the last few years? Because usually, of course, moving is not the only thing that people use self-storage for.
Yeah, it's actually increased in 1 in 3 in every Americans. And, it's interesting.
Has it still increased even though people aren't moving?
Yeah, I mean, we see about, a little bit of our customers not using self-storage at the moment because of the lack of movings. But, what we're actually seeing is customers are staying longer.
Right.
Because, normally people move and they use storage for a couple months and they move out. Right.
Right.
Those customers aren't around, but we're actually seeing more stability in the industry from the standpoint of people are moving in, and the people that are moving in are the people who are actually going to stay there for a long time, which has been terrific. But what we're excited about this year,
I was going to say, what are you excited about?
Yeah, they're putting in the new Fed chair, right? And the new
Right.
Fed chair is kind of hell-bent on, at least getting after interest rates. So we've already seen interest rates fall a little bit, even under Powell, who's been, kind of really holding back on that and being conservative about it. Once those interest rates go down, people need to move. They haven't moved. America hasn't really moved since 2022. We're not buying houses. We're not selling houses. People aren't moving for jobs. As the job markets, gets a lot of pressure, people are going to have to relocate to take these jobs that are becoming fewer and fewer. So I think that's a big deal in our industry, because you take the lack of supply in self-storage that's upcoming this year, new inventory is down, and you have all these people who put off their moves for the past, half decade, call it, starting to think about buying a house and moving. It's really a recipe for a lot of returning demand. And we're already seeing early signs of that in the recovery of asking rents for self-storage. We're seeing them to start to tick up. We're starting to see that reflected in our numbers. So we're pretty excited about that.
That's fantastic.
Tait, you mentioned baby boomers, I think, on a previous episode. I know we had Dwayne Clark come on from Aegis Assisted Living, I think a year or two ago. And, I was actually talking to him quite a bit about this, and I wanted to get your thoughts on it.
Yeah.
But he was saying, he hasn't really been able to build assisted living in a long time. I think the last project he had built and open was maybe 2 or 3 years ago. And it's been difficult to sort of I think assisted living communities are kind of going through the same thing, which is hard to build, hard to operate. COVID, put the clamps down on a lot of operators. What trends are you seeing in assisted living?
Well, yeah, and this is a huge one that I'm really excited about. So, haven't really talked about this on the show much, other than that one episode, like you said, that we did with that gentleman Dwayne, who runs a number of beautiful facilities up in the Pacific Northwest. But we've been interested in the senior living space for a long time, and that is because of one very easy stat to track, and that is how many people live in the United States that are of a certain age. So if you take everybody in the US that is 30 years old, 31 years old, 32 years old, 33, so on and so forth, right? You'll see this bubble, and that's the baby boomers. And they've slowly been working their way to the right on the chart. And the first baby boomers a few years ago started turning 80. And there is this massive demand bubble for senior housing. Now, there was a total black swan event curveball that killed this entire thesis, and that was COVID. And so I'm really glad that we didn't get into anything in 2018 or 19 when we were really interested in the asset class to get ahead of the trend, because we would have been very ill-timed. But I mean, COVID just absolutely destroyed senior housing NOI, net operating income. I mean, in some cases, 60, 70, 100%. And it has only slowly started to recover. And what I love is, I love looking at data. The demand side is one thing, and we're talking about supply. Senior living did not see the oversupply that multifamily and self-storage and even industrial saw over the last half decade since COVID. A lot of these commercial real estate asset class coming out of COVID, tons of capital flows. People are trying to invest in it. Lots of stuff getting built. That never happened in senior living because NOI was still destroyed. And so we're at multi-decade lows in construction, while at the same time, the number of seniors over 80 years old in the United States over the next 7 years is going to increase by about 10 million. So we currently have about 13 million, just over that, of population that's over 80. That's set to increase by over 5% per year for the next decade. And, the average population growth of the United States is like 0.6, 0.7%. So, Ryan, I mean, we get excited when we're doing a self-storage deal and there's like, anywhere from 3 to 5% growth. When you look at a segment of the population that is going to be growing at 5% over the next 10 years, and there's just not enough in the pipeline to support that, we like that confluence of trends.
Yeah. And the baby boomers, guess what? Unfortunately for the millennials and everybody else, they have all the money.
51% of household wealth is controlled by the baby boomer generation. So, if you don't think that there's money to spend on dignified, high-end stock, I mean, you're out of your mind.
Well, I mean, I kind of like how Dwayne put it too. He's like, look, my client, he's kind of the Four Seasons of assisted living, right? These are high-end, really good. And he said, look, the client is an aged out, elder who can sell their home, who's got a ton of equity, who can roll that equity essentially and fund their living. And so you kind of look for these markets that have, high equity in the homes, aging population. Yes. You can really match the product that they're looking for, the experience they're looking for, to the income that they can actually do. But, one thing, Tait, that I wanted to ask you about was, kind of your knowledge about operators in the space, because Dwayne, really harped on the fact that there's just a lot of operators that just don't understand the space. They don't get how to run it. They don't, and there's also too, I wanted to pick your brain on sort of, I've heard everything from like people taking a house and converting it into like rooms that have,
we've all heard that sales pitch
all the way to like the Four Seasons, right? Where it's like full service, turnkey and all that. What are your thoughts kind of on operators? Because I've heard a lot of like, be really careful on the operator.
Yeah. So if I may, there's basically three segments. There's independent living, which is exactly what it sounds like. It's like, there's some services, but essentially you're in a townhouse, whatever, with maybe on a golf course or something like that. There's assisted living, which typically is just as it sounds. It's maybe in what would look like a multifamily apartment building, but there's, obviously medical staff on staff 24 hours a day. And then there's memory care. And as you go up those tiers, the regulatory hurdles are much more complicated and burdensome. And so, you really need to be working with a team that understands those regulatory issues. You need to be careful what state you're in, depending on what sort of political environment. And, because, I have a colleague who's in a state legislature and plays a lot of defense in well-meaning legislation, but unintentionally harmful to the industry. So you got to be working with somebody that understands that. And then I would say the other part of it is labor. The biggest tough spot of senior housing is labor, because these are difficult jobs. You're working in a challenging environment. People are frail, they're aging. It's a tough place to work, and it typically doesn't pay phenomenally. So you have to be with a group that understands labor and understands how to hire and has a strong company culture and can retain talent.
Yeah, no, I think that's so important. And, you know, kind of talking about that a little bit more on the operator front, what about building them? I mean, can you kind of talk to, sort of, are you kind of, I know that you're kind of looking into both building and buying them, kind of what's your thoughts on that?
Yeah, thanks. I mean, good question. I mean, I think that development is kind of where to be right now because, like we said before, a lot of the stock is old, and there's a lot of money in the system right now. Baby boomers have a ton of money; they've got a ton of equity. There's money to spend. Ryan, you and I both have parents who are aging, and it's not a fun thing to go through. But at some point, if they need care, and this is somewhere where we're going to make a decision as a family, you want that product to be new and dignified and beautiful and a great place to spend time. You don't want it to be dingy and old and depressing, right? So I think the development side makes a heck of a lot of sense in the current market. It is more complicated. It's a lot more complicated than building industrial. I can tell you that. And then, of course, you have a medical aspect as well. So again, just like in the self-storage space, you don't want to be investing with somebody who doesn't have any experience and doesn't understand the nuances of maybe that niche micro market climate or the tiny nuances of how to conduct ECRIs, existing customer rate increases. You want to be working with Ryan if you're investing in storage. The same thing, if you're investing in senior living, you want to be investing with consummate professionals who understand the below the surface stuff that it maybe isn't as obvious.
I love how you said that because there's so many people out there that are doing senior living, right? And so like you see a lot of people who are like, I'm doing senior living, and everybody.
Right.
So it's like you got to be really careful. You got to be selective about really vetting the operator. And I'm really glad that you said that.
Yeah. So yeah, Ryan, I think the last thing I want to talk about are interest rates and capital flows. And before you asked me about senior living, something I wanted to talk about in terms of where we are in the market cycle are what was capital flows and cap rates and valuations. So we talked about the fact that valuations kind of came down in commercial real estate. It's a vast generalization, first of all, but on average, across the board, nationwide, not talking about any specific locale or asset class, but just in general, things came down in value. Because as debt costs increase, somebody can't pay the same price, right? If I have to get a 7% interest rate, I can't pay you as much for an asset as I could if I could get 3% interest debt. So that variability happens in the form of cap rates. And we've talked about cap rates on the show before, but essentially cap rate expansion means that something is worth less for the same amount of cash flow stream. What I wanted to point to here is the fact that because interest rates are starting to come down, capital is starting to come off the sidelines because, for a lot of years when interest rates were at 5.5% at the Fed funds rate, the risk-free rate, you could buy a T-bill and make 5%. So it's like, why did you want to go and do something else with it that introduces all this risk when you could just make risk-free 5% money? Interest rates are coming down now. So that is pushing some capital off the sidelines into taking action. That's one of the reasons why we're seeing activity start to pick up in the real estate market, is because people are going, all right, I'm not getting as good of a return over here as I was. Let me pull this cash and put it to work somewhere that's more productive. So in any case, you can put it to work on the equity side, which is what everybody's familiar with. You invest in a deal, Ryan goes out, gets bank debt for the rest, and you ride the wave of appreciation up on that property, right? Let's talk about investing on the debt side. Because that's something you can do as well. You can invest as a debt investor and you don't participate in the upswing in property value, but it's a much more secure place in the capital stack to be a part of. And you instead just earn interest rate and higher than what you'd be getting in a T-bill. So Ryan, what are your thoughts on that? I want to hear about your debt fund.
Yeah, no, I mean, I think debt investing is huge, right? Because I think investors, and I don't think, we haven't really ever talked about debt funds on the show, but, there's a lot of different ways debt funds work. But I just want to come right out and say, look, if you're at a money market making 3.5 or 4%, you're missing out on like 5% interest right now. Like
Yeah.
you're literally leaving money on the table.
Absolutely.
And I think it's really important to go in eyes wide open into a debt fund and really kind of think about what it is. You have this thing called redemption, so people can actually call back the money. So, for us, we have a debt fund where you can make 8% per annum or 9% per annum. That's what I mean about the 5%. If you're only making 4% in the money market, you're literally missing out on 5% interest. If you're making 4% and you want something a little shorter term liquidity, meaning you can redeem in 90 days, we have a 8% payment. And so I've actually seen a huge uptick in that because I think investors are seeing their rates kind of come down.
Yeah.
And so not having it just sitting in savings or sitting in a money market, people are kind of starting to come over and invest more in that. It's also really good for your IRA. And the reason why is because, if you invest cash in a debt fund, that's fine, but you're going to pay income on ordinary rates on the money that you make, and there's no depreciation offset. So I think that's kind of a big thing that investors need to know about in that. But if they're doing it in their IRA, it's not subject to the taxation that you would have, especially like a Roth.
And that's because, a pure debt fund will throw off a 1099-INT instead of the normal K1 that you would get. Now, there are some debt funds out there that throw off a K1 just for, we have one.
I think people, when they get K1s, they don't think that they're subject to interest.
Right.
So it's really important when you go into your K1, you may invest in a debt fund and it may say like, oh, you get a K1, so you get the tax break. However, you got to be careful about box 5 because box 5 is what's going to capture all of your interest expense. So just because they have a little bit of equity in them and sometimes they have all that debt in them, you're still going to get taxed on the interest income that you receive from making notes.
Correct.
So I think that's, I got to be honest, and I've only, when the podcast is something that I do, with Tait because this is all the stuff I wish I would have known 10 years ago. Right. And so you get these K1s, and actually it surprised some of our investors this year because they may have invested in like a ground up development where there's no cash flow, but all of a sudden they get a tax bill and it says that there's interest income on their tax return. And they're like, what's this? Why do I owe taxes on a deal? I thought this wasn't going to happen. It's because the money sat in the account and made interest. And because the interest has been so high in the last couple of years, it's actually creating a taxable event on a ground up development. It's kind of funny. I mean, it's like we're talking about like $1,000 here of like interest income.
Yeah.
But it is important that just because you have a K1 does not excuse you from paying taxes on interest accrued. So
absolutely.
Again, when you're thinking about debt funds, the IRA can be a great vehicle to invest with because of the tax sheltering. So
couldn't agree more. And, I find that the more sophisticated the investor and the higher their net worth, the more they love debt. They love investing in those debt positions. And I'm following that same trajectory. It's like, as I grow my net worth, I want more money in debt funds because it's safe and it cash flows. And it's like, it's amazing what you can do over the long term with, high single digit, low double digit returns with no volatility.
And I'll say for those investors out there, if you're listening with your spouse, I will tell you from personal experience, if you are just getting into this type of investing, debt fund investing is the best thing for your spouse's sanity.
Yeah.
Because when you're doing this type of investing in alternatives and those checks show up every month, it's kind of like, okay, this actually is a thing that works. If you go invest a bunch of money in a ground up development or, something that's not cash flowing right away, the anxiety level goes up because is this working? Am I getting the benefit from this?
2-3 years is a long time to wait for a payday, right? And you're going, boy, I hope these investor updates are, reliable.
Exactly. I could see the relief in your face, Tait, as we're talking through this. I mean, yes. I mean, it's so true when an investor comes to me and says, hey, where should I kind of go first? I always say that the best thing I like to put people in is the debt fund. So I think the best thing about the debt fund is, you have that monthly income coming in every single month. And so it's just, it provides that consistent cash flow that investors really enjoy.
Yeah. Couldn't agree more. Well, with that, those are the trends. That's what we're tracking for 26. We're super excited about it. I'm taking off. Actually, when this airs, I'll be in Houston for a big energy conference. So we're looking forward to that. And Ryan, I hope to see you soon, man. We need to hang out.
Yeah, I'm off to Whistler. When this comes out, I'll be on my kids' midwinter break.
Nice.
Getting some skiing time in with the fam.
Amazing.
So
Well, I hope you enjoy it. I've got holes in my skis from Breckenridge last month, so I'm going to have to get some P-Tex out before I get back on the slopes.
Nice.
But
I
until
thought you were a
then,
big snowboarder.
I do both.
You do both. Okay.
Yeah.
Hey, you're really good at snowboarding. I remember that from the time that we first met. So yeah.
Thanks, man. I think I showed up in
job.
a real colorful one piece ski suit, and you guys were like, "Who's this clown?"
I think the technical term is like fart bag or something like that.
That's right. That's it. That's a technical term. Yes. Yes. It's from the 80s. I got it off eBay. It's pretty cool.
I think it looks great. I think it's awesome. I think you looked fantastic. So
thanks, buddy.
All right, Tait. Good catching up, man. And thanks for tuning in, everybody. We'll catch you on the next episode.